Welcome to Frontier Conversations, a podcast by Foresight. We explore what lies beyond capital, diving into the ideas, people and opportunities shaping the future of investment.
So Richard, great to be with you today. Thank you for taking the time to hang out with me and talk about energy infrastructure investing.
Not like we hang out too much anyway, but
I know. I mean, it's definitely true that our wives probably think we spend more time together than we do with whether it be on the road fundraising or out
finding investments.
Finding investments, exactly, all over Europe. So, energy transition has become the largest subsector for infrastructure investing. It has become an established infrastructure asset class. I would say of everyone I know, more than anyone, you are a man of infrastructure. I know from the times we have, whether it be at airports or sitting on trains going to the north of Sweden recently, there'll be lots of commentary from you on the infrastructure, what's good or bad about it.
It's important to be observant about these things.
It really is. It really is. I'm interested. How did you first become an infrastructure investor, and how did that then lead on to your role within driving the energy transition?
Yeah, so probably fair to say an infrastructure investor is not everyone's childhood dream as such. But I think I found my way into infrastructure investing initially in kind of social infrastructure and transport projects through kind of PPP type structures, so privately financed public infrastructure. And that was, I like the fact it was something tangible. You were financing, building something. There was a tangible outcome at the end of it. So I spent a number of years in the UK financing kind of hospitals, roads and other projects. I spent a couple of years based in Toronto investing in the North American market, again, sort of similar sectors. And then 2012, I kind of moved back to the UK, decided, that's where home is. Back to the UK and joined Foresight, and since then I've been involved in the building out of the infrastructure team, and that was sort of both energy and non-energy projects. But I think sort of 2015 onwards, real focus from my side on energy, and now the energy transition, as you well know, Dan, is sort of kind of everything we do. That our energy transition strategy is what we both spend all of our working time on now.
It is great to work in an area where you can see the physical output of your work. And I was thinking this when we were in the middle of Sweden. Literally the middle of Sweden. Our wind farm, yes. Chevallen, which is now operational. Within that site is the middle of Sweden,
with a nice little sign and a barbecue hut that we've actually built there.
Exactly,
yes.
The barbecue hut for the snowmobiles.
Indeed.
Sverige meter, I think, is the kind of Swedish translation.
Say your word for it. Yep.
This is an opportunity for you to talk about the size of those turbines. They are monumental things, aren't they? Can you remind me how tall the actual towers are?
The tip height. Let's go for the tip height. That's the biggest number. So over 200 meters. So kind of vast machines. At the time we built our first Swedish wind farm, they were the largest onshore wind turbines in the world. So that was our claim to fame in our industry, as it were. Coming back to sort of how we got into infrastructure and energy. What was the moment that you sort of realised that the energy transition would define your career?
Well, great question, Richard. I would say there were kind of two moments, really, looking back. The first was very early in my career when I was working in kind of regular corporate finance advisory in the energy space, but in the kind of generalised energy space. I was working in oil and gas, nuclear power, all sorts of things. I had a bit of an early midlife crisis in terms of thinking about what I wanted to do with my life. And for me, actually, the route in here was basically sustainability, and feeling like I wanted to contribute something to sustainability and how we would sort of re-pivot society, and in particular through climate. So I hadn't really thought about it from an energy perspective initially. So that was when I was working for EY back in the early 2000s. Then through a career of working for another investment management firm, spending some time in Asia, deploying capital into broader sustainability areas like sustainable natural resources, but lots of clean energy. And then coming back to the UK in 2012 and joining Foresight the same year as you, which is obviously a very big year for Foresight.
Big year for Foresight,
exactly. I would say the next moment when it really felt like the energy transition was going to be defining, for me, was about 2016, because by that point, obviously, we collectively had done a lot in clean energy, but there were a couple of things that really showed that the world was changing fundamentally. First of all, renewables have become cost competitive. So they were starting to outcompete fossil fuels in terms of what was being added to the system, even without subsidies. And secondly, you'll recall this, 'cause I think you led the deal. We made our first battery storage investments that year in 2016. And that was the first time we started to see that investing in clean energy wasn't just renewables.
Yeah.
It was something more fundamental than that. And that obviously was the moment when we then started thinking about the future and how we would drive an infrastructure investment strategy that would be based on looking at all the components of that future energy system. And we started to think about generation, storage and grid as being like the three kind of pillars of the strategy. And if we sort of take that question about different technologies and different forms of infrastructure, where do you feel the most capital will be allocated in the coming decade? Will it be areas like solar? Will it be wind or battery storage, for example?
So, I mean, I think in terms of quantum of capital, most of it is going to go into solar. I mean, the sort of the scalability, the modularity of it, the pace at which costs are coming down. The fact that in all parts of the world you can utilise solar. So I think that would be the most. Wind and solar are going to make up the backbone of the energy transition. Batteries, lithium-ion batteries for the moment, providing the sort of storage element. I think the big area where we need to get capital, though, that's going to unlock the energy transition, unlock those bottlenecks, is actually investment into things like grid, things like long duration storage. That's sort of harder to invest in areas. I think that's kind of areas where specialist managers can add real value in driving capital into those assets, building them out, and that unleashes the ability to connect far more renewables to the grid.
Yeah. I think that's exactly right. We talk about the fact that the energy transition has got now these tailwinds pushing it forwards, market forces, wind, solar, batteries. Costs have come down so much that it just fundamentally makes sense economically to invest in those areas. We've got a very favourable policy landscape in the EU, in the UK, and what we're seeing that where the energy transition is kind of being held back, is more the physical limits of the grid itself.
Yes.
It's the fact that we don't have enough interconnection, we don't have enough storage, and that sets the kind of backdrop to what we're doing. It's worth calling out solar. You mentioned solar as having that largest sort of capital requirement globally. That doesn't necessarily mean it's going to be the biggest focus for us as infrastructure investors.
No, that's true.
But it is just worth mentioning that although we are talking about this whole kind of system changes, the growth in solar really is extraordinary. It is the fastest growing energy form of in history of any kind. It has mass applicability across the vast majority of the world. A statistic I heard recently, we won't make reference as we speak to a recent report from our good friends at EMBA on the electrotech revolution, and talking to our good friend Kingsmore Bond there, one of the authors of the report, he was talking about the fact that 97% of the world's population live south of Birmingham. So the point being that the vast majority of the world does have access to good solar resources, which is why it's such a good form of energy. If we look at Pakistan as an example, in prior years they had built out a lot of gas infrastructure on the basis that they were going to import US LNG. Post-COVID and Ukraine invasion, Europe basically bought up all the gas.
Yeah.
Pakistan had suffered blackouts, and in the last 18 months they have now pivoted and invested hugely in solar, and diesel demand is falling extremely rapidly there, and that's just a good example of why solar is such a disruptive kind of force in this world.
No, exactly. And you mentioned those market forces, which are sort of generally are unstoppable now, fundamental market forces. Solar is by far the cheapest form of generation. Another stat I heard the other day, same amount of solar power hits the planet every 5 days as the entire amount of fossil fuel resources forever on the planet. So, that's just a signal of how much resource is there.
That's amazing. So, I mean, that statistic to me illustrates the point, and I think the phrase again is in the EMBA report here, that really when we think about the future of energy, we should realise that we now have the technology to use the sun in real time, rather than burning its fossilised remains.
Exactly.
And it really is as simple as that, and I think we shouldn't be surprised that society has got to a point where that technology is available, and that it's not a case of wind or solar power being kind of flaky renewables. But of course, we can't have solar power on its own. We need to think about things from a systems perspective. How would you articulate a whole of systems approach in energy?
Well, I guess the word I'd articulate is you can't make an energy investment now in isolation. You have to know what's happening across the energy system in that market, what the different levels of renewables build out are. You have to understand what's happening with demand in that market, and so you have to understand the level of interconnection between different national power markets. And so when making an investment in the energy space, you've got to understand how all those different components fit together. So it's a very different world to what it was 10 years ago, when you might be able to make a renewables investment and almost look at it like a quasi-bond fixed income investment.
Yeah, exactly. It's a very different world, isn't it? And there's complexity there. But in that complexity, would you say that gives us more ability to plan portfolios?
Absolutely. Going back to that point in sort of 2015, when you and I were starting to think about this strategy and sort of the evolution of the energy market, we felt that particularly in the enabling assets, so those bits of infrastructure that are needed to help integrate renewables into the grid, so storage and increasingly long duration storage to help manage the sort of variable generation profile of renewables, and then grid assets to address the more distributed nature of those assets. So we felt there'd be real opportunities there, and those assets, particularly sort of long duration storage and things like international interconnectors, they are few and far between. We had conviction at the time that these assets would have long-term strategic value, kind of monopolistic characteristics, but also that fact that they would unlock the ability to invest into more renewables. So they had this kind of impact as well. And so that's both of those are sort of reasons why we've kind of introduced them into the strategy, or made them a key part of the strategy. I think the other point is just about how you're able to put these assets into a portfolio, almost as a risk management tool. These assets behave differently in different market environments, and so having generating assets and a mix of technologies within that, having storage in the fund and having interconnectors, those storage and interconnector assets behave differently to generation assets. So something that's good for generation might not be good for storage and interconnection. And so that was a sort of key thesis really behind the strategy, was having these assets in the same fund created a bit of a natural hedge and just gave a more consistent return in a range of market outcomes.
Exactly. And I think that final point is so critical. So we know the core drivers of the energy transition. We know that the cost of solar coming down, the cost of wind, batteries, means that those three technologies are kind of the backbone of what's changing everything. But we don't know exactly how the energy transition is going to play out at what speed in different places. And so that point, to maybe give an example of what you're talking about then, in terms of sort of negative correlations between different assets. We know that it's good to have wind and solar together. That's kind of intuitive. They're sort of complementary resources. But if we are invested in a particular technology like solar in a particular country, we are predicating that investment on a particular assumption for how quickly solar is going to roll out in that country. If that rollout happens faster than we expect, that's actually bad for our solar investment. But if we have storage, it's good for the storage, because obviously it's introducing more volatility into the system. What do you feel then? What do you feel are the biggest barriers to investing in the energy transition or investing towards net zero targets in private markets? Do you feel the barriers are more capital availability? Is it regulation? Is it availability of technology?
I think the answer is probably different for different parts of the market, I would say, would be the first point. In terms of the generating assets, we're in a world now where investors are having to sort of take power price risk into their portfolios. And so, there is a availability of capital point there. That is not a risk profile that will appeal to every pension fund investor in the world. So, that's where the sort of value of having those assets within a diversified portfolio actually really comes through. So I think for generation assets, it is about the kind of return level and availability of capital. For things like grid and long duration storage, these are absolutely critical assets if we're to kind of make best use of the renewable resources that are there. If we're to hit kind of net zero targets, we've got to have those assets on the grid. But they are, very capital intensive, have very long development cycles. And so you need the regulation there. First of all, you need access to private capital into those markets. Private capital needs to be able to play in those markets. But you need to have the regulation to enable that capital to come into those investments. And I think, the UK, has its challenges in some areas of the energy market, but I think the UK is, I would say, somewhat of a leader in terms of introducing those policy mechanisms and allowing private sector capital into those assets. The regulator in the UK has introduced competition where it can into transmission assets, which is quite rare. And so we've seen offshore transmission assets, so the links that link the offshore wind farms to the mainland, they are now tendered to private sector capital. And we've seen that drive savings for consumers because it's brought the cost of capital of those assets down. We've seen interconnectors regulated, so international interconnectors through a cap and floor structure, and we've got a good example of that on our Maris Connect investment that's in the first fund. And those types of regulatory mechanisms drive investment. We've also seen regulatory mechanisms in the UK for grid stability projects through the Pathfinder scheme, and that's led to investment into things like synchronous condensers and grid forming batteries. So, that regulation is absolutely critical, and that's driving investment. We've now seen the cap and floor scheme for long duration storage in the UK, and we've been lobbying government for that for probably a good 3-4 years now, and that's benefiting our pumped hydro project in Scotland. So these forms of regulation are key, but they're not available everywhere. And so I think at a European level, where we're seeing lots of rhetoric around the need to invest in interconnection, storage and grid in order to bring down power prices across Europe, to make Europe able to compete from a manufacturing standpoint with the US and China. But although we're seeing that rhetoric, and we saw a 400-page report from Mario Draghi this time last year, I think it was, really pushing for that, but we're not really necessarily seeing that flow through yet into those sorts of policy support mechanisms in Europe that we have seen in the UK in the past.
That's right. We're obviously both Brits. We tend to not be very comfortable with talking up our country. We tend to say that things are generally rubbish, but it's fair to say that the UK is and remains a bit of a pioneer in those kind of areas. And that's the evolution we're on. Is that we need support not just for the generation assets, but for flexibility and grid. On that, I want to zoom in on a particular sector now. If I was to give you the statistic 111 million kilometres, would you have any idea what that might reference?
I would, because I've heard it in a range of investor pitches we've been in, Dan. But that is the required distance of the grid by 2050.
Spot on. So according to Bloomberg, yes, that's how much we need to build by 2050. And I think you're about to give me another reference on that as well.
3/4 of the distance to the sun.
There we go. Absolutely spot on. And it's an extraordinary statistic, isn't it? 3/4 of the distance of the Earth to the sun is how long the combined transmission grid globally needs to be by 2050. So we know that we require a huge amount of capital to finance that. What would happen if grids are not upgraded in time?
Again, to coin another one of your phrases, actually, Dan, but sort of postcards of the future. I think we've seen across the world in different places more instances of kind of grid-wide blackouts. Spain's the one that we're all referring to. Texas a few years ago, 2019, we had a partial blackout in the UK, and these are kind of driven by, not necessarily just driven by renewables, which is quite often the message that's peddled, but it's about the grid system not being kind of fit for purpose for the generation mix that is there. What I mean by that is we're in a world now where we've got more distributed generation, smaller individual projects. The grid needs to be able to cope with some of those projects coming offline. So things like interconnection between different markets is really important from a security of supply standpoint. So if you do have instances of power projects tripping out, you can draw on that power from other markets. So interconnections are huge. With renewables on the grid, renewables don't provide inertia to the grid. So if you think about the way power generated historically, big coal and gas power stations, spinning turbines, and those turbines which have inertia are able to react to changes in frequency on the grid and help to balance the grid. Now, when you move to renewables are non-synchronous, and so they're not providing that physical inertia to the grid. And so you have to then start looking at, well, how do you create that inertia? You can do that with synchronous condensers. You can do it to some extent with grid forming batteries. But the grid has to evolve, and if it doesn't evolve, it will become more unstable.
That's right, exactly. And I think it's it's at almost three different levels. If there's not enough investment in the grid, we won't be able to connect renewables up to the kind of distribution network. National transmission networks won't work as effectively as they should do. We see areas like in the UK, for example, where there's lots of wind in the south of Scotland. If there's not enough investment in the grid or in things like long duration storage, we'll see more curtailment of renewable energy. And then, as you say, that international inter-system piece about interconnecting different systems is critical, because what we're looking to build here is an energy system that's bigger than the weather. And that's the whole thing, is to benefit from solar in the south of Europe, wind in the North Sea, in the future in the Atlantic. That's how we get to a system that is the lowest cost, that is reliable in that it is consistently producing 24-hour-a-day power, and it is resilient to absorb shocks to the system because it's distributed enough. So whether it be storm damage or cyber system failures, whatever it might be, we need those three elements of low cost, reliability and resilience.
And I think the cost point there, the price to end consumers is an important one, because there may be a bit of retrenchment from kind of net zero messaging at the moment, but the point is here, clean renewable energy is the cheapest form of generation, and providing we can make best use of that through increased storage and better interconnection between grids, then power will be cheaper for industry, it'll be cheaper for individual consumers. And so that for me is almost the point that's not sufficient focus on, is effectively that sort of welfare gain really through the upgrade of the energy system.
I want to ask a couple of questions about valuation and how we value assets, and I want to look at maybe a couple of different subsectors and just think about how we as investment professionals would go about thinking about the basics of valuation. How would you think about, in the first instance, what are the key considerations for valuing a wind asset, a solar asset, so a kind of a regular renewables asset? What are you thinking about in terms of the building blocks of that valuation?
Well, it's a dry subject of valuation, but I guess getting into valuation, we're looking to project what that asset is going to generate in terms of cash flow over its life. So these are long-lived assets, typically kind of 35 years, and so we're wanting, to the greatest extent possible, certainty over our cost base, certainty over our revenues. And that gives you a cash flow stream that then you can discount, and you can therefore place a present value on that. So it'd be the sort of key valuation.
What would you say that we've learned about the valuing underlying resources, so wind resource, for example?
The resource is a sort of key factor in renewable generating assets. Clearly, solar radiation and wind resource are variable. I think, with solar, there's a far greater level of predictability. The sun rises on time and sets each day, so you may have a difference in cloud cover, but you know the timing of that solar resource. Wind is more challenging. It's more challenging when you're predicting that before you've built the assets. You can't kind of measure it firsthand. Wind patterns change year to year, so there is inherent variability, and for decades, a whole ecosystem of consultants and advisors who model and project what that wind resource is going to be. I think it's fair to say we have seen, probably a bias towards those pre-construction wind yield forecasts being over-optimistic rather than the other way around. So that's definitely a factor. But I think the other thing is just climate impact over the long term. So, is it getting less windy? Is kind of one element. What is happening, as a result of changes in climate from a temperature perspective, and how does that actually impact the operation of the physical assets? So, that variability is sort of key. So lots of stress testing in terms of seeing what kind of downside scenarios look like and factoring that into the underlying valuation.
Yeah, absolutely. We're lucky in that as Foresight as a whole, so in terms of all the funds we manage, not just FEIP, collectively own in excess of 400 infrastructure assets at the minute. So we see these things on a real-time basis. You mentioned climate risk. We're seeing all sorts of examples of that across the portfolio, and we're learning from it. So that is something obviously that shapes the way we think about managing assets, but it shapes the way we think about valuing future assets. I'm going to ask one more example on valuation. I'm going to move to the flexibility bucket now. In particular, investors will increasingly hear about some of the technologies that will be seen as solutions to some of the challenges you've seen. So batteries, you mentioned synchronous compensators, sometimes called synchronous condensers a minute ago. Putting your infrastructure valuation hat on, how would you think about those two kind of buckets of infrastructure assets? Batteries, grid-forming batteries, and then synchronous compensators on the other hand.
Yeah, so I mean the underlying revenue streams are different, I guess, is the first point. So in a generation asset, you are selling each unit of power, and ideally you will try to contract that power up front and get a fixed price, so you know exactly what you're going to earn for each unit of power. But then on the flexibility assets, you're actually earning your revenues through kind of the volatility or the spread between high and low power pricing. And as you have more renewables on the grid, you end up with more volatile power pricing. So that spread is larger, and that's the sort of opportunity that these assets are playing into. So that's if you like the underlying revenue stream in the wholesale market, as well as being able to provide different services to the grid. So things like frequency regulation and other ancillary services. And then it's a case of can you overlay any contractual frameworks to then kind of de-risk those revenue streams. So on the wholesale power side, the arbitrage, you can put in place things like tolling agreements or floor contracts to provide yourself a sort of guaranteed level of return. And these are the sorts of things that typically we'll see certainly for battery storage projects. You mentioned synchronous condensers. They're actually, it's a different type of service, and so those projects are actually providing inertia, and that's I'd argue even harder to forecast the underlying price that could achieve over the long term. But again, there are contractual overlays. We've seen, I mentioned the UK projects earlier, so there is a sort of an availability-based payment stream. So I think it's the same underlying approach, in terms of valuation. These are the infrastructure assets that you do a DCF, a discounted cash flow on to assess the value. But it's always all about understanding that cost profile and the revenue profile over the longer term, understanding the difference between, risk attached to power pricing and risk attached to, the volatility and the spread that I mentioned. And that's, some aspects of flexibility. The other thing, of course, we haven't covered is like long duration storage. And these are some of the kind of larger strategic assets that we've been focusing on in recent years. And the UK there has introduced a cap and floor mechanism for those assets. Still the detail of which is being finalised, but expecting to see the first project securing that support in the middle of next year, middle of 2026. And that's a regulatory regime that the government's used for interconnectors over the last decade. It's proved to be very successful in bringing project finance into those assets. And those types of revenue streams are, provide essentially inflation-linked floors. So, again, providing that greater level of contractual certainty, which brings down discount rates and aids the valuation.
Yes, exactly. So I think what you've illustrated there is just there's multi-dimensions to this. We're just talking about a few of the areas that we might invest in. If we take that point about storage and flexibility, I think what you've just explained there is that there are needs for that flexibility in 3 different timescales, and they have different valuation considerations. In the middle is the kind of multi-hour time-shifting elements of power trading, moving maybe solar power in the middle of the day in California to using that in the evening, and that's where batteries obviously have a role to play. Long duration storage, as we get beyond 8 hours, is increasingly needed in more deeply decarbonised energy systems. And then at the other end of the spectrum, keeping the grid in balance on a second-by-second basis. We should all understand that the historic system consisted of, and still consists to this day, of a system which has a lot of very large spinning pieces of metal, basically continually speeding up and speeding down. So basically the turbines in gas or coal-fired thermal plants acting as huge cushions on the system, keeping things in balance. And so that's where there is need for these other technologies. It could be batteries providing, as you put it, synthetic inertia. Yep. It could be synchronous condensers being simply artificial large spinning bits of metal that provide the services. And then I think, as you've been saying, from a valuation perspective, when we look at these, we will look at those different revenue streams and probably allocate different levels of risk to them.
Absolutely.
That kind of power arbitrage stuff you're talking about, those are quite deep markets. Like it takes you need a lot of batteries before you take out volatility in the power price. But I think what we've seen is that the markets for ancillary services, frequency regulation, can be saturated very quickly. A synchronous condenser can't provide services beyond ancillary services. That's all it does. So we will price it at, we'll obviously price a contractual period, but probably take more of a conservative view on anything on a merchant.
Yeah, absolutely.
Just talking, I want to talk about impact, sustainability. Do you have, I guess, we talk a lot about what we are working towards is systems change and all contributing to a decarbonised power system. From your perspective, what do you feel are the kind of impact objectives that investors should think about or track, or how should they measure a contribution that they're...
I mean, investing in the energy space now, the clean energy space, what investors are investors are doing something that is inherently green. It's impactful. It's helping to decarbonise the power system. That is having a actively slowing kind of climate change. So there's the fundamental kind of benefit there, and measuring kind of greenhouse gas emissions, carbon, kind of life cycle carbon emissions, and so on, is all key. I mean, I think what we're really seeing though is in addition to that kind of direct benefit, things like investing into assets that unlock kind of bottlenecks to the energy transition, that's almost more impactful, because by removing those bottlenecks, you're allowing many more renewables projects to be connected to the grid. There's almost a sort of multiplier effect there that happens, and so I think that's also something that investors should be kind of cognizant of and place value on.
I think you've hit the nail on the head there with something really important. So on the one hand, it's important for us to hold ourselves to account. It's worth saying that our fund, the FEIP strategies are SFDR Article 9. That's the kind of darkest green badge, as it were. We have made a commitment to invest in assets that are aligned to the EU taxonomy on sustainable activities. That's not an easy thing to do. It's quite a high bar.
It is.
And what we're doing there is we're holding ourselves to account by saying it's not just what we do, but how we go about things that's important. But I kind of feel partly what you're saying, and certainly what I feel, is that what we should not do too much of is talk about how we are not part of the problem, as it were. We could talk about emissions, and that's fine. Absolute avoided emissions are a very subjective area. What's more important is to just focus on what we are doing to contribute to the solutions, what we are doing, what we're building. Long duration storage is a great example of that. The more long duration storage that can be put on the system in sensible ways means that the more renewables can be accelerated in terms of deployment, and acceleration of fossil fuel retirement as well. And that's where we collectively are starting to get useful data. I think Ofgem have put out data, and certainly Aurora, the consultancy, have contributed to this. Data around the fact that long duration storage in the UK with some sensible investments can halve UK power sector emissions by the mid-2030s. So I feel like that's sort of the message we want to convey to investors, and we do try to convey to investors, is how can you be part of the solution rather than kind of waving something around and saying, we have only emitted X, whatever it might be, which will be a relatively subjective term.
I think the other thing there as well is, it's recognising that, these assets do also have some negative impact, and it's about trying to sort of put these assets onto the grid in a way that minimises that impact. And so, in building your wind farms, reducing the amount of carbon that's kind of emitted it through that process. And we've had quite a bit of success in one of our Swedish assets where we sort of managed to bring down the carbon associated with the construction of the asset. So using elements of recycled steel, batching concrete on site to reduce the amount of truck movements. So things like that. On the long duration storage side, there is an impact on the local environment. We have, through our Scottish asset, we're investing into a project there that's actually kind of remediating what was a disused open cast coal mine, and so actually it's having a net positive impact on that area, because it's taking something that is a scar on the landscape, and it's actually kind of reinstating that, creating a reservoir as part of that pumped hydro storage project, and that will actually have a sort of positive kind of impact on the local environment. So it's about focusing on the right sorts of projects, as opposed to projects that might pumped hydro projects that might involve flooding a valley, where actually there would be a bigger sort of impact on the local environment. And so it's those types of projects that we'd steer away from.
Yeah, absolutely. I think that's a good way to bring things to a close. Are there any areas, Richard, we haven't touched on that you would like to touch on? Any questions you would like to ask me? Or do you feel like we've done the energy transition now?
I feel we may have done I fixed the energy transition in the last half an hour, Dan. But
yes. Well, it's a pleasure talking to you. Thank you very much for taking
always.
the time out of your day, which is spent with me anyway, to speak with me further. And
nice to be away from the office, though.
Yes, nice to be away from the office. But we probably better get back to the office and talk about the energy transition more.
Indeed. Thanks, Dan.